Hello, everyone, and welcome to the NinjaTrader Ecosystem Webinar Room. Today, we have a very special event with Brent of SpotGamma. My name is Juanita Archuleta, and I'm the NinjaTrader Ecosystem Representative here at NinjaTrader. Before we get started with today's webinar, I do have a few housekeeping items to go over. Please remember that this presentation is presented by NinjaTrader LLC, which is the technology company responsible for developing and supporting the NinjaTrader trading software. Any brokerage-related questions should be sent directly to our brokerage team using the following phone number or email address. Lastly, if you are new to NinjaTrader, please make sure you sign up to receive a free NinjaTrader demo with real-time market data. Our platform is always free for advanced charting, strategy backtesting, and trade simulation. Before I turn the mic over to Brent, it's important to understand that futures, foreign currency, and options trading contain substantial risks and is not suitable for every investor. It is possible to lose all funds or more than your initial investment. Risk capital is money that can be lost without jeopardizing one's financial security or lifestyle. Only risk capital should be used for trading, and only those with sufficient risk capital should consider trading. Past performance is not necessarily indicative of future results. Also, please remember that these training sessions are not a solicitation nor a recommendation, but simply educational in nature. Thank you again for joining us. And without further ado, it is my pleasure to welcome to the NinjaTrader webinar room, Brent of SpotGamma. Go ahead and take it away.
Great, thanks. Appreciate it. Hello, everybody. I know it was a wild trading session today, and so we'll stick to being on time. So thank you again, everybody, for joining. We're going to keep this one fairly basic. I know, for instance, David Blake's on. He's been with us for a while, great trader. And so many of you are probably familiar with a lot of the concepts that I'm going to touch on here. But for those of you who are in the NinjaTrader ecosystem and are a little bit new to how and why options can impact the stock market and the futures market, we're going to touch on those base concepts. And then we can even discuss a little bit of what happened or what we saw happening in the market today. So for those of you who aren't familiar with SpotGamma, I am the founder, along with my co-founder, Matt Fox, who's not on this presentation at the moment. But what we essentially do is we monitor all of the options positions for all 3,500 roughly different stocks and ETFs in the US. And we predict how hedging flows, that is how banks and market makers will hedge those options positions, as they're the counterparties, obviously, to a lot of those options trades. We predict how their hedging flows will enter the market and how those hedging flows will impact the market. So will it cause more volatility, less volatility? Are there certain support and resistance lines which are key or important based on these different hedging flows? So as the typical risk disclaimer here, this is for informational purposes only. Please do not trade off with this information and consult a financial advisor, etc. Please read the disclaimer for more information there. So first, why should you care about options? For those of you who are not familiar with the options complex, or how those hedging flows may invoke volatility or change or create changes in the way the markets move, we wanted to present just a couple of examples. Earlier in January, this was actually February, so last month, into the third Friday of every month, which is options expiration, there are large options positions which shift around. So we talked about this at length in this piece here. You can see it's called the Deep January OPEX. You can read that on our blog. But basically what we saw is an example of how OPEX can affect the movement of markets. We saw very large equity positions, call equity positions, that were set to expire on the third Friday of January. And on the 14th, so this is sort of the week before, this is roughly mid-January, this is the week before expiration, we said, look, there are roughly $120 billion notional of call deltas expiring on this January options expiration. And if you assume that the bulk of these call positions are long, meaning that traders bought these call positions so dealers and market makers are short, what that was telling us is that there could be somewhere around, at maximum, $100 billion of long stock held by market makers and dealers that had to be sold on the Friday, January 18th. And we discussed this kind of at length, but basically what we want to point to here is that you could see these positions, these call positions were set to expire on the 18th. We flagged this the week before saying, look, there's volatility headed our way, and it's something to be aware of. And what we saw, obviously, was very large drawdowns into that 18th, the options expiration, into the 21st, which is the expiration itself. And then the Monday after was sort of the low in the market. We pulled down Monday the 24th, nearly 4%. And we think a lot of that had to do with the shifting in and around this options expiration. People will assign headlines to these events, but we said, look, the week before, pay attention to the 18th, the 21st, because there is this big options expiration, and that can invoke volatility. And then what you may notice here, as we sent out this note, you may notice here on the 21st, obviously, there was a lot of volatility. And the 24th, which is the day after the options expiration, is when sort of the low in the markets hit. And we had some other data that showed how options positions were shifting around that low, and that may have sort of signaled that the bounce was due. So again, options.
So again, the options market invoked volatility here. Moving forward, just to give you another example, many of you may have heard this out of me before, but if you remember back to periods of major volatility in the past, December 18th, many of you may remember the whole Mnuchin incident, wherein I was on Christmas Eve day, that was a half session, and he was calling the banks, and people are saying, oh, this is terrible, and there was a major low put in that day. Well, that was the Monday after a very large December monthly expiration. And the same thing with this past March, the COVID crash. That low was the Monday after the quarterly, so the monthly March expiration, which happened to be a quarterly expiration. Obviously, December was a quarterly expiration as well. So these, two data points, as well as this January, these were periods of major volatility. The low happened the Monday after very large options expiration, and we don't think that is much of a coincidence. So this is just one example of why you should pay attention to the options market, even if you're not an options trader. So again, we're going to cover the basics here. There are two basics. One, how options positioning big open interest lines or strikes with big open interest can be support and resistance zones. And then two, the second thing we want you to walk away here is volatility expiration. In other words, how much can the market move? And we believe that basically any futures trading strategy could incorporate these two elements, right? Whatever your existing strategy is, are you a swing trader or something, some other type of strategy, you can overlay these resistance lines, overlay these volatility expirations, expectations, and hopefully improve your existing strategy. So what do we do? Well, again, I mentioned before, we look at the entire options complex. I'm going to focus on the S&P 500 here. This works the same in the NASDAQ. But basically we say, okay, here's where all the big open interest areas are in the S&P 500. And we predict, one, where are the big support and resistance zones? Obviously, those lines, those individual levels, which you're seeing here, are where there are big strikes with large open interest. And our theory is, and we have some data obviously to support this, is that where these big support and resistance lines, or where these big open interest pockets are support and resistance zones, because options hedging activity picks up around these areas. And what we do for people is we map these big lines, these big support and resistance lines, onto charts that says NinjaTrader. This happens to be TradingView, but I'll show you what the NinjaTrader looks like in a second. So what we do is we take these lines and we map these support and resistance strikes onto your chart. And so they look like typical support and resistance lines that you may have seen, through, say, Fibonacci or technical analysis. However, our information is completely derived from options. So if you take, for example, this large gamma strike, the large gamma strike tells us that at 4,000 in this particular snapshot, the strike with the most amount of gamma, the most amount of hedging activity, is the 4,000 level in the S&P 500 on this particular day. And so based on that, anytime that the market rises up into 4,000, you should see hedging flows come in, which pushes the market back down to the 4,000 level. And also, if the market drifts below 4,000, there'll be hedging flows that pick the market back up into the 4,000 level. So it becomes something of a pin. Many of you are familiar with this concept of the options pin, right? And so in a large positive gamma market, that is something that we would expect to see. And again, this is around the concept of hedging flows, which occur around these big strikes, these big support and resistance line, that make them, that create the support and resistance, right? It's the hedging flow, not say a moving average where other people may know that's a moving average, or a Fibonacci line where people are watching a Fibonacci and expect some market movement based on that. This is purely off the idea that that these levels, or hitting these levels, invokes or brings hedging flows into the market. So we take a look at how this works for NinjaTrader, for example. So each morning around midnight, around 2 a.m., we push out these levels. They automatically update. So you can download this little widget once you're a subscriber, and we will push out these levels to you. So the gold bands, the gold lines here, are the support and resistance lines from our system. Again, they update automatically every day for you, and you can see how the market responds to these support and resistance levels. Now, obviously, not every single movement in the market is controlled by options, but what we try to do is focus on the main areas, the big areas where the options position is prevalent, and then we think that that will obviously have an impact on the way that the market moves. So the second idea, the second concept which we're hoping to relay here is that of market volatility. So many of you are probably familiar with the GEX term, or market gamma, and the whole purpose of that exercise of measuring how much gamma is in the market is to predict or forecast how much volatility there may be in the following trading session. So for an options trader, you probably understand, okay, well, I want to know how much implied volatility there is, right, in the market so that I can trade some options. But if you're a futures trader, it's also important to you because if you're, again, say a swing trader, you want to know, should I be trying to achieve, 50 handles today or just 10 handles, right? How can I sort of get an estimate of how much the market may move or the forces in the market? Do I want to, again, try to scout for a percent or 2%, or again, or smaller moves what I should be playing? So when you look at the amount of gamma in the market, on the x-axis is our gamma index. And this is something that we produce in daily notes every day for our subscribers. When you see a lot of positive gamma, that are positive numbers on this x-axis, you can see that these dots here on the scatter plot are very concentrated, right? And so on the y-axis, what we have is the one-day forward return. So what is the market going to return tomorrow for the given gamma index reading? So for example, here, if I just kind of point one random dot, you can see that there was almost no movement or no return in the market yesterday. So as gamma gets more positive, the concentration of the position, right, the concentration of the forward return gets smaller and smaller and smaller. In other words, the more positive gamma we detect in the market, the smaller the one-day forward return is. Now, positive gamma, the way that you hedge positive gamma, if you're an options trader or you had an options portfolio, is as the market rises, you would sell futures, and as the market declines, you would buy futures. So the more positive gamma you have, the larger your positive gamma position, the more notionally you're going to hedge. So the more dollars you have to sell as the market goes up and buy as the market goes down. So you can imagine if you are a huge player, had a massive, book, $1 billion notional to trade, you could see how that could suppress volatility in the market, right? Every time the market starts to rally, you sell, and every time the market starts to drop, you buy. That squashes volatility and creates these very tight returns. Now, as we transition lower to a negative gamma position, the characteristics of negative gamma hedging are that as the market declines, you are selling now as the market goes down, and you are buying as the market goes up. So you can see that if you had, again, a very large book and the market is dropping, you're shorting futures, you're going to make the market drop faster, right? And consequently, too, as the market rises, you're going to be buying, and that's going to cause a rally, right? The market will rally harder or faster as you trade because you have this negative gamma position. Now, to determine whether a positive or negative gamma position exists in the market, that's part of our models. And so essentially what we do every morning is we send out this note. We say, here, everybody, here are the key levels to watch for today. And here you'll see something called the SG implied move. This is how much volatility we forecast. In other words, on this day, it was 77 basis points. And that forecast is based purely off of how much gamma we see in the market. So you'll note in this case, a 77 basis points is a 1 standard deviation move. So we give a 66% chance that the market stays inside of 77 basis points from the open to the close, and that is purely derived off of this gamma-based forecast. Just as a point, a note, this morning we had our gamma flip point at around 45.50. So the amount of volatility in the market was somewhere in and around this level here, and so we forecasted in our AM note around 1% open to close range is what we expected the market to move. So that's a 1 standard deviation bet. If we move lower below 4,500 into tomorrow, our volatility expectation shoots much higher. We're going to be looking for probably a 1.5% intraday move. So that's open to close. Basically below 4,500, the volatility window opens up. So you can see the distribution of returns widens greatly as we shift really below -1 in the gamma index, right? As we go less than -1, so -2 in that area in our gamma index, our volatility expectation opens greatly. And what generally happens is you cross the higher strikes, the higher prices right now in the market have positive gamma positions. You have a positive gamma market. And as you move lower, you kind of invoke this negative gamma position. So the sell-off, as you sell from above the zero gamma line, above say 4550 in the S&P, down below 4500, you invoke this negative gamma hedging. And that is really what expands volatility in this instance. This sell-off, in other words, if we break 4,500, is going to be different from a normal sell-off in that we could see a much wider distribution of prices or much higher volatility as we break lower. This is a same way of looking at that chart here. So again, every morning we look at all the S&P 500, we sum the gamma, and that's what's printed here. Now, if you were to look at the position on a daily basis, many of you are probably familiar with this gamma curve here. What we're showing on this chart is that this is the gamma notional. So here's zero gamma in this case across the middle here. And in this green area is the positive gamma environment. This is where you expect volatility to be suppressed. And that positive gamma is generated by call positions. So not surprisingly, if you look at strikes above from current levels, you'll see mostly call positions. Those call positions are what bring positive gamma to the market and suppress volatility. Below, not just on this chart, but also in the market we currently have, below 4,500 is mostly pure put positions. And the hedging of put positions is what invokes this negative gamma and volatility, right? You can imagine that if you were a market maker right now and you were short a bunch of put options and the market just started selling off right now, you would have to act very quickly, right, to try to hedge yourself and to try to keep up with any downdraft in the market. So the characteristics, again, of the positive gamma and negative gamma, you can almost just think of, look, if we have a positive gamma market that's generally characterized by a lot of call positions at strikes near where we're trading, and a negative gamma market is characterized typically by put options and a lot of puts around where we're trading. And for today's market, 4,500 is kind of that dividing line between a lot more calls up around the 4,600 area, and then below 4,500 tends to be at the moment mostly put options, and that is really kind of what invokes that volatility. In our daily note, in what we sort of send out every morning, we try to succinctly provide everybody with this information. So what are the key levels that you should pay attention to based on the options market? I would note that our big level today was 45.20, and that was where the market sort of, the futures just before the open bounced off that level. We rallied all the way back up to, I believe, around 45.80, and then we did sell off kind of and closed right at 4,500. And so you'll see all those levels in the daily note. But basically what we show here are, where are the dealers in this note? Where are the dealers likely to start, supporting the market in terms of positive gamma flows? Where they like to flip? Where are they likely to flip and start pushing volatility into negative gamma position? And then, what are the other major lines, strikes with major open interest that you should pay attention to? So you'll see that in this reference note again here. Here's our gamma index. Here's the amount, our expected one-day volatility, how much volatility you should expect. At what point, in this case, we mentioned the gamma flip line. Today's was around 45.20. So at what point, should we expect volatility to go from low to high, right? Where should we expect, tail risk to come in? Not every day do you come into the market with an elevated tail risk, right? But when you have a negative gamma position, you should expect you should anticipate the possibility of much more volatility or a much bigger move in markets. And then again, what are some of these other key levels to watch based on big options positions? Again, it's all about predicting and forecasting hedging flows and how those are going to impact the market. Now, the second component here, everything that you saw, all of this is based on the open interest that changes once per day, right? That's the only change that you can make, because open interest is only updated by the regulators as the OCC, the Options Clearing Corp, once per day. The second part of this is what flows are coming in intraday, right? Today, everything was going great according to plan until I believe it was Bostic came out and said he's looking for a 100 basis point rate increase, right? Or several rate increases to get us up 100 basis points. So that kind of really was not what was the market expecting, and that created this slide lower. And so what happened there? Well, we have this new indicator called HERO. And what the HERO does is it estimates the hedging impact of options in real time. So that's why we call it HERO. And what you can see is this chart on the left. This is the price of the QQQ index. And this is for the 28th. And what you see in this purple line are the deltas that are trading in real time. Now, why do we look at deltas? Well, deltas tell you the new hedges that are required for options dealers and market makers based on the options flow that comes in real time. So you'll note here, we posted the actual trades. These were some very big put spreads that were closed on the 28th. And what you can see is that these put spreads, when they're closed, create big positive deltas in the market. And we believe those big positive deltas would be met with dealers buying stock, buying Qs or buying futures in order to hedge themselves. And so you can see there's all of a sudden roughly around 1 p.m., 12:45, somewhere in the neighborhood on this day, we saw these very big chunky put positions being closed. That registers as these jumps higher. The fact that it's a jump higher, a straight line higher, is telling you it's a very large trade, right? Because the deltas suddenly move up. So big chunky put trade, another big chunky put trade. These are puts being closed. There's 3 of them in kind of relative close succession. Those are big. Those are telling you big players are closing their put positions. They're buying their put. They're selling their put positions. Excuse me. And that we think in kind dealers need to buy back stock, and that creates this rally in the market into the end of the day. So you can see this not only we have dozens and dozens of examples at this point, not only in the Qs and spiders, but also in single stocks as well. And so you can see now, okay, now that we have the piece of what the position was, right? This is how the market opened. This is what hedging flows around these opening positions. What is actually the flow happening intraday, and how's that going to affect or impact the market? We would note that we saw very big put positions today in the Qs in particular, right around that 12:45, 1 o'clock Eastern time. That Bostic headline clearly invoked some hedging flow, some people buying puts. So instead of seeing a line shoot up, the line was trending down today, suggesting that people were putting on new put positions. So as the market sort of selling off, dealers had to sell futures or sell Qs in order to maintain their hedges. So if you find this information particularly interesting, we have basically 2 ways you can work with us. One, we have this SpotGamma, we call it SpotGamma Pro, and you get a free 7-day trial if you go to spotgamma.com. We will give you the links to the NinjaTrader, so you can link in your NinjaTrader system with our daily levels that plot on the chart. So that is this chart that we showed kind of at the top. So you'll get this automatic update. You get a AM note from us that comes around 7 a.m. You get a PM note every single day. You get access to all of our equity levels. And if you're interested in this hero, looking at this, we're going to be giving all subscribers to SpotGamma in the month of February. The last week of February, you're going to get a 1-week free trial of Hero. So this will show you the real-time options trading position in about 120 different names. So that'll be part of the SpotGamma Pro trial subscription. And then the second thing we should note, if you go to academy.spotgamma.com, if a lot of this gamma and delta that was new to you, we have a course set up, and we have an instructor, Imran Laka. Imran trains banks. So Bank of America, for example, he has this course that he set up that he uses to train new derivatives traders, and that is available to everybody at academy.spotgamma.com. There's a couple of different levels of education there, but that is a fantastic course for those of you who are new to options, or for those of you who are trying to maybe advance from the basics of gamma and delta up into the more advanced Greeks. If you, I'm happy to take some questions immediately after this, obviously, but if you're interested in getting in touch with me, we are at spotgamma.com. You can hit me at SpotGamma on Twitter, and then we have a lot of videos and information on our YouTube channel, as you can see here on the chat. So with that, I'm going to end this show and leave it open for some questions. I'm going to leave the presentation up here just in case anyone had anything to ask there. So Stephanie McKett asks, what is gamma? So specifically, gamma is the rate of change of delta. So that is probably a little bit confusing to you, but basically, if you think about the way, let's just pretend, Stephanie, that you bought a put option from me and I'm a market maker. When you buy a put option from me, you bought that put option. I'm now short a put option. So if the market starts to go down, I'm going to lose money. Because obviously, since you bought the put, you're going to make money as the market goes down. But me, as the guy who's short the put, I'm going to be losing money as the market goes down. So the way that I would hedge myself would be to sell some shares of stock. And the amount of shares of stock that I would sell is called deltas. Delta is what we would use to measure that. So let's say at first I would need to sell 50 shares of stock. And this is all determined by an options pricing system like a Black-Scholes model, right? So this is all the computer basically telling us what's happening. So initially I need to sell 50 shares of stock. Now what happens if the market goes down 1%? Well, you're happy as the put owner, you're making money, right? Because the put went down, but I'm losing some money because the put dropped, and the likelihood of your put being now in the money or making more money has increased because the market's gone down. So because the likelihood of me losing money has also gone up because the market has declined, I need to sell some more shares of stock. That additional incremental share of stock is called gamma. So if I was short 50 shares of stock to maintain my hedge, I need to sell another, say, 10 shares of stock. That additional 10 shares of stock I'm selling is called gamma. So again, it's the rate of change of delta. If you assume that when a put trade is initiated, or a lot of puts are traded today, right? All those are going to be delta hedged immediately. But as the market moves around, I need to adjust my delta. I need to adjust my hedges. So all those hedge adjustments are called gamma. Somebody here asked volatility for S&P only or big cap too. So the reason that we focus on the S&P 500 is because it has a very large consistent options position. The options positions in the S&P 500 have been very large and consistent, meaning there's a lot of open interest day in and day out for 20 or 30 years now. In the NASDAQ, the NDX options complex is very thin. It changes rapidly from one day to another. And that's why we don't offer a volatility forecast for the NASDAQ. I will say that there are some stocks we're looking at, like Tesla and Apple, that have some larger, more consistent options positions that we are considering launching a volatility estimate for those names. So at the moment, the volatility estimate is only for the S&P 500, but we are looking at adding that to the big cap stocks too, namely Tesla, Apple, and there's one other I'm skipping on my mind. Oh, the Qs. Now that the Qs have a week, they now have an expiration 3 days a week. We think the open interest will pick up and be a little more consistent there. So Stephanie asked again, does our class explain all this for newbies? We talk you through what is a put and call if you start at level 1 class, and we walk you through what is a put and a call all the way up to the advanced concepts like gamma and charm and a lot of those other kind of buzzier words that you hear now. You don't have to start with the 101. You can start with a more advanced class if you want, or we have something, I've seen get a bundle basically that takes you through everything. Our clients use this technology or these levels to trade futures, stocks, and options. We have a lot of people that do all three. And so again, it's about volatility. How much do you think the market's going to move? That's going to mean something different to a futures trader than it will to an options trader, right? But you can use the information kind of either way. If you're only trading intraday trading in the ES, I think this information is extremely helpful. Again, these levels update every single day. You'll note David Blake is on here. He sits in the UK, so he'll use these levels to trade in the overnight session. We update these levels every single day. In fact, our forecasts are generally, I think, valid really on a 1 to 5 day basis. At most, we look at 30 days out because the open interest in options is changing over so quickly. And Greg, I would also note this intraday indicator is brand new. We're launching it to the world basically on March 1st. And so existing subscribers or people who are trying it out now will get a free week trial of that. The flows that you see coming in this real-time impact to me are really incredible because you're seeing how big options trades come into the market immediately. So if you think the market is set up for a bounce, right, but then you see that, oh, look at the options flows agreeing with him, right? Positive deltas are being generated, and that gives you that extra confidence you have to play a dip, right? It really can be invaluable. And, it's something that I'm extraordinarily excited about. And I think this specifically has an impact for intraday traders, we believe. One sample trade, is listed really right here. You can see these big positive options deltas came in the market in the stock rally. We've documented on YouTube dozens of different things. I would note that if you go to zerohedge.com, we posted on our Twitter, but Zero Hedge posted a little snippet of our note today. We commented on how the 45.20 level was this major level for support in the markets. And you could see the market open right at that level. We did break through that level late in the day. That was after those Bostek comments, but you could see the sort of on a second drop, we paused at that level again. That 45.20 is a big area for us. We call it our volatility trigger. And our model picks up that there's a big base of support, of hedging support there. Now that hedging support only lasts for so long. If you keep getting flows, selling flows, obviously any level can be overwhelmed. But those positions, right, that 45.20 that we documented is a big hedging spot for dealers, held wonderfully at the open, and then it revisited again on the second leg down. So again, go to zerohedge.com. You can see if you search for SpotGamma, you'll see where they posted our level this morning and a snippet of our note. Second thing too, if you go to our site, spotgamma.com, a pop-up box hits, you can type in and we'll send you this morning's note so you can read what the note is. The 7-day trial, it's free. Check it out for 7 days, look at our notes, see if that information helps you. If it doesn't, cancel, no harm, no foul, right? The options trading course is not free. We do have a course called 30 for 30, which is free. That is on the SpotGamma site as well as our YouTube channel. So there's plenty of free information. Here is the NinjaTrader chart, Greg. Don't know if you got a chance to read that. Gamma is the velocity of delta. You could think of it that way. Yes, Stephanie. So we do offer a historical data download for the S&P 500. That is on our portal. If you're a subscriber, you can get access to that information. We do offer daily levels in the Qs and the IWMs as well. So when I say Qs, I mean NDX and Qs as well as the Russell and IWMs. I don't know. I cannot answer the question about E-Trade accepting NinjaTrader with SpotGamma. Maybe send that one over to support. Apologies for that, John. Not sure. How would I describe zerohedge.com? Zerohedge.com is a financial news site. That's how I would describe them. So, okay, it looks like that we have kind of elapsed any questions. I know as well we're kind of pushing up against our time limit here. It looks like one more just came up front. You don't pay up front. You do have to put in your credit card so that at the end of 7 days, your card would be charged. We send you alerts to let you know, hey, your trial is coming up. And between me and you, we will, if you have a good reason for missing a payment, we may refund. We don't refund everybody for any excuse, but look, we're in the business of trying to make people happy. And so if you don't find the information valuable, we alert you to the fact that you need to cancel your card. But I suspect that you will be happy with the trial information. There are 3 levels of offerings basically at spotgamma.com. There's a standard service, which is right around $60, and that goes up to $120 roughly based on the level that you choose. So if you're interested in just sort of the standard index products, SPX, Qs, et cetera, or if you want to see all of our single stock information, all of those prices are going up on March 1st because we are launching this hero indicator and adding in a few other things. So it's a good time to try it out if you are interested. A percentage of success of forecast. That depends on, I suppose, what you're looking at. If you're looking at our volatility estimates or specific levels, we do rank the levels in terms of strongest to weakest, which is why on this chart here, you'll see a levels 1 to 5. So 1 is where the most gamma is, down to 5, which is the least gamma. A percentage success of forecast is a little tricky. I guess if you want to say sort of stay inside of a band or inside of a range or respecting a certain level, I don't really have a great way to answer that. But I will say again, you can try it for free. And after 7 days, particularly with the amount of volatility in the market here, if you're not finding interest in not just these levels, but sort of our commentary in the market, I will say that there's a lot of people who just kind of want to hear the way that we're seeing the options positions line up. And then they go and trade sort of using their own methods after that. But again, around 7 o'clock in the morning, we send out a note every single day describing our position and what we see in the market. That lower price is locked in. Good question, Stephanie. Great. So with that, I think we'll end here. I know we're kind of reaching our bound of time. I really appreciate everyone taking the time to watch our presentation. Again, if you have any more questions, please email them to us at info@spotgamma.com.
Thank you again, Brent, for taking the time to share with us today. If you enjoyed today's session, we hope that you join us in future webinars. We'd like to remind you the information provided in this was that of SpotGamma and not of NinjaTrader. All information was for educational purposes and should not be construed as trading advice. Enjoy the rest of your day, and we hope to see you in future webinars. Happy trading from everyone here at the NinjaTrader ecosystem. Have a great day, everyone. Thank you.
Thanks, Juanita.